All right, it has come that time in which we will bring in tech trader Sean Udell to talk about a few things tech related, Micron earnings, Pandora's M&A news. But first off, good morning, Sean.
Morning. How are you guys doing?
I'm doing quite well. So you mentioned, last week that you thought Micron's earnings might be somewhat exciting now that they've already came and went. Did it turn out as exciting as you thought?
Yeah, because it's in fact it pretty much went exactly as I thought. I thought they'd have a big beat for the current quarter, but then there's basically I think they did it exactly right too. By the way, there was really no upside for them trying to yet again raise guidance, and so it's kind of one of these things where, companies obviously are supposed to report what they feel is going to happen to the best of their knowledge. At the same time, there's quite a bit of judgment wiggle room that a company has when it comes to reporting guidance. And some companies just guide very conservatively. That's just the company policy. Steve Jobs and Apple did for years. And I kind of think that's the case. I would be shocked if they don't handily beat the guidance that they provided. But again, the market we're in, and given kind of the state of things right now, some China fears, and just kind of where, again, the broader tech cycle, which I've talked about, which most companies, it's getting tougher, comps are getting tougher, and all that stuff. So, there's really no upside for them to come out with a big aggressive guide, because had they done that, the stock might have popped a little more, but it'd probably end up being about where it is right now. So, the longer it either stays here at the current prices or goes lower, the more I like it. I'm starting to get pretty bullish on Micron again. My view and my cycle work is, I really tend to like them when other people don't like them, and when they're getting too close to the bottom of their fundamental earnings cycle. And they're probably there. So, and the best part of the new Micron, if you will, but it's not really the new Micron. It's the Micron that probably should have gotten the benefit of the doubt before it did. But this industry is much consolidated. In fact, David Tepper was on and basically echoed comments that I've been making for years on Micron, that this industry is pretty much an oligopoly now. And pretty much, in fact, Micron basically made it an oligopoly with the buy of Elpida. So in fact, the last two big buys that Micron did and that Western Digital did pretty much turned the industry into an oligopoly. So it's a much better industry now than really it's ever been. And again, Micron got. The last down cycle they were in, the stock went to $10. Again, it should have. I think part of that had to do with how beaten up and how cheap tech stocks got in the spring of 2016. Again, that was basically a great crash that nobody has ever talked about as a crash, because the indices didn't crash. The indices had a big correction, but you had huge numbers of tech stocks that went down 50 to 65%. You had huge. In fact, the whole energy group went down 67%. The whole biotech group went down something like 72%, and pretty much almost all of tech under mega cap went down 35 to 55%. So, you basically had a market crash that nobody will ever probably have classified as a market crash. So that was part of Micron getting as cheap as it was. But yeah, no, I'm moderately bullish on the name. What would get me really bullish probably would be your next question. Would be kind of just price action if some fear came into it. If we saw something a little crazy, like 32, 35-ish. Or below. And it could do that because it doesn't have much, there's really not much support on the stock really below where it is here. There's pretty good support at like 42, 43. But really below that, there really isn't a lot of support until you get down to there's really good support between like 28 and 32. And I don't know if it's going to go that far, but so sometimes stocks will kind of almost go make a new support area if there's not a good one at a price point close enough. So maybe it settles. You could almost do a Fibonacci and say, hey, what's sort of 50% between here and 28, And that lines up probably pretty good to around 35ish or something. So that would get me really, really bullish, where I would say, look, I'm going to build a position, I'm going to buy it and build a position, and maybe even make it a decently sized position. In fact, at 35, I might even sell some Qualcomm and buy and swap some Qualcomm into Micron, especially if Qualcomm's 80, Micron's under 40. I'm getting 2-to-1 shares, meaning for every Qualcomm share, I'm getting more than two Micron shares, something like that. So we'll just have to see. But I think you could buy it here. But here's my view on everything. It's like, I kind of think there's a setup that there just are times it's better not to do a whole lot. There are times where it's better to just let things kind of play out. And if you're one of the guys that sits back, it's sort of like the guys that were smart enough not to buy real estate when real estate was expensive, and that just sat back, and then all of a sudden, 2 years, 3 years later, they're like, I was looking at this house at $600,000, and today it's $250,000. And I'm not saying you're going to get prices like that. I'm just saying, there's a whiff of a correction. There's, we're kind of in that pre-earnings season. You got the China stuff is starting to get maybe almost a little overblown now. Meaning the trade, the worries about trade are probably going to get more overblown than they really ever should. So anyway, you kind of add it all up, and if you're sitting back and kind of waiting for really good prices, you might get them on a few things. And Micron would be one of those names you might get them on, because if you get more tech selling, and just if the indices ever correct, a Micron could drop 10 or 20% from where it is here. And then, and that every 10% below 44 just makes it that much more attractive. But in fact, this one I'm going to work this over. In fact, I'm going to do a new top 20 list next week. Micron could be in it again. But the one thing I'm going to do, no matter what I do, I'm going to rework my my price target on Micron, because I haven't changed it for a long time. I mean, I was basically at 45 on that stock when the stock was at 10. So I didn't really feel a need to make it, and I didn't really feel a need to raise my target on it, just because it went to 60. Because look where the stock is now. So for a long time, I kind of felt 40 to 45 is right. I can see a path to kind of maybe old highs and higher. I mean, the one thing I'll say, and I'll close on Micron, is when the very first $100 price targets came out, I kind of thought they were laughable. And, the stock's put in a pretty good 20-point down move since some of those price targets have come out. At this point, I mean, if you have a long enough time frame, 100 might be doable on it. I don't think I'm going to come out with a $100 price objective, but probably I'm going to be more in that $65 to $75 range is probably where I'm going to settle out, based on my metrics and where I think it can trade. Because I don't want to put a number there that it hits and only attains and holds for 5 minutes. So my view is if I put a price objective, I put it out that's something that is the stock can maintain for more than a few weeks, not just a couple minutes. But yeah, I mean, I can easily see a path of sort of 65 to 75 on this name, and possibly higher. So I mean, now they're going to go into the sweet spot. So now everybody's going to doubt that they're going to have much growth or whatever. But the one thing they're going to do is they're going to produce prodigious amounts of cash flow for the next 4 to 6 quarters. So, and that's just every quarter they produce a lot of cash flow and the stock doesn't go up much, the valuation just gets that much more attractive.
So my first question regarding what you said is based somewhat on your premise that you would be more inclined to get involved in this one should it dip down into the low 30s, we'll call it. And you said that...
Well, low 30s would be crazy. That would be like hyper attractive. Kind of 35 to 40. So anywhere in 35 to 40, I'd probably start nibbling on it.
All right. Now, you said that you might swap out some Qualcomm for this if it were to go lower. Now, why wouldn't Qualcomm... Let's assume Micron trades down there below 40. Why wouldn't excuse me, why wouldn't Qualcomm go with it? Because it would seem that if Micron would move on that, then Qualcomm would as well, because we probably have something underlying in the Nasdaq as a whole that's bringing things in,
Well,
altogether,
but
right?
I mean, to answer that question, I think you could almost look at how Qualcomm stock has traded versus Avago and Skyworks and, most of the chip sector. I mean, we've had, one area, so we haven't had an index correction or a correction in indices, but we've had a hell of a correction in the stocks. So the semiconductor index has corrected quite a bit, especially if you kind of consider a correction both of time and price. But we have a decent correction off of highs of the year, which, by the way, the SOX hasn't really done anything since January. It did post a slightly better high in mid-March, but it's been it's hard to find a semiconductor stock that hasn't produced pretty good results this year too. By the way, it's just that the good results were pretty much baked in and expected. But yeah, so Qualcomm was 50 and it's gone up 50%. While the rest of the stocks is basically traded flat to down. Avago had a 20% correction or more. Skyworks has had a big correction, again probably 20% or more. So Qualcomm's countercyclical. At least right now, their results and their cycle, they're coming out of their own trough and probably heading into a really good cycle where the rest of semiconductors kind of work together. And then the one thing I'll say about semiconductors is that they probably still have fairly tough comps for another 3 or 4 quarters. But Micron's kind of its own beast. Micron doesn't. I wouldn't say Micron really trades with the SOX. If you look at the move that Micron made, let's say take out the extreme 10 low, but start from, let's say, 18. Micron 18 to 50, that performance didn't mirror the SOX. It did its own thing. So Micron can kind of trade on its own. Qualcomm can kind of trade on its own. The 5G cycle isn't tied to the broader semiconductor cycle.
Now, another semiconductor name that I really want to ask you about was one that had earnings, I believe, last night or this morning. So I'm not sure if you've had a chance to look at it, but that's Jabil, JBL. It's had a pretty interesting move today. They had a modest beat, inline guidance, but this one really just trades in a really tight range. You've never brought this one up. Is there any particular reason why you don't like this one?
I don't know if I don't like it. I have bought this. This is kind of one of those stocks that basically trades on Apple love, if you will. So meaning their good quarters pretty much are due to Apple. They do a lot of business with Apple. It's not really a semi-name, by the way. It's a contract manufacturing company.
Okay.
So like I think they make. I believe they make the shells for the iPhones, for example. They make a lot of circuit boards. This company is just like a Flextronics or just like a Celestica, or there's all these contract manufacturing companies. What's another one? I don't know. I used to follow this group. It's a weird group, by the way. There's quite a few names in the group. I have traded this stock. I've traded JBill. But yeah, it doesn't do a lot. It's kind of a weird. But basically, you almost kind of have to wait till this one just gets kind of dumb, and then it's a very good thing to buy if they really hammer it, because it's a very steady company. So it's kind of funny. It's a stock that really should trade like the company's results, and it's a real steady Eddie performer. Not a big grower, but also doesn't have periods where they have huge declines in revenue or earnings. It's just kind of a real steady Eddie. Yet the stock will have big, go to kind of these spike highs and spike lows on relatively muted misses and stuff like that. So the best time to buy that, put this way, if they got down to around 26, they'd probably be a good pickup, because it's having a pretty good percentage move on probably results that aren't that different. You know what I mean? It's just kind of one of these funny stocks. But yeah, this one doesn't probably meet my, I like companies that can kind of be more disruptive innovators. This is a very good company. A company I have favored instead of this one, for example, has been like Fabrinet. So Fabrinet's been a stock I've liked instead of JBill. I'm trying to think of other things I would kind of put in this category. I don't know. I tend to kind of like software companies that make technology that is harder to replicate or harder to copy. So I don't know. I'm trying to think of like it would sort of be akin to if I talked a lot and traded Honeywell in names like that. Even though it's not a Honeywell, it's sort of like that. I don't really trade names like Honeywell. But it would be something kind of in that, I don't know. To me, that's the mindset that you kind of have to be in to be a trader, be active in a J-bill circuit.
Okay. Yeah, I always lump them in the semiconductor group. Maybe I mislabeled them a bit. So
I mean, they might do some of that, but they really are. They punch a bunch of stuff out for the big electronic companies. So they punch a lot of stuff out for. At one point, in fact, Juniper was, I believe, their largest customer. This was years ago, but they did. They punch out networking stuff. They punch out computer boards. They punch out stuff for iPhones and iPads. Very necessary food stock in the food chain, but they're unfortunately these kind of companies don't get a whole lot of love. I remember years ago, in fact, Flextronics was a really, really good buy, and some of these stocks have kind of been re-rated and traded way better in recent years. But yeah, I'm just looking right now. In fact, Flextronics was a penny stock. Which it was probably a penny stock doing, I don't know, like $10 billion of revenue a year or something. And they eventually got their due. I mean, if you held them for a while, they ended up giving you double, triple, quadruple, and more. There's other better performers. I used to follow this group a little bit more. I mean, I could quickly pull up a big list of them. Plexus is another one, PLXS. That one's a little more volatile, but yeah, it's an interesting group. But you almost have to kind of become an expert in this space, which I'm not.
Yeah, interesting. That Plexus chart looks similar on a very tight consolidating time frame. So you got to squish your chart a little bit, but you can almost see the same type of chart setting up.
Probably the same, probably moves the same, but Plexus has been probably a bigger winner long term than J. I'd have to go back and look at like long term charts, but I want to say that Plexus. I mean, when was I look? When all these were good buys was probably around 2012, 2013, because a lot of these hadn't really recovered a lot. So their business was doing just magnitudes better than it was like in 08, 09. But you could buy a lot of these contract manufacturers in 2012 and 2013 at roughly the same prices as kind of close to their lows in 2008 and 9. I'm saying close, probably 50% higher or something. But I mean, these were businesses that had improved, 3, 4, 5-fold. Because some of these companies, there was concerns that they were going to go under. And I think a couple did. A couple either went under or got consolidated. But yeah, 2012, 13, 14, but I think 12 and 13 was a great time to buy into this space because you literally, I think all of them doubled or more. And then spring of 2016, this whole group got decimated again. It didn't go down to the 2012 and 13 lows, but there were a lot of good buys in the spring of 2016 on this space. So you almost have to watch this group, and if you ever get a tech wreck, these are like instant money because they're companies that you don't have to worry about that they're going to be around. They're very safe. So it's just a matter of being able to buy them when everybody else is puking up everything.
All right, let's step away from the semiconductor space and talk a little bit about Pandora. Now, I have to give you kudos because you were out on this one a long time ago. I don't exactly remember when, but it was several months ago when we were talking about Pandora. You had brought this one up, and you suggested that Sirius might be a suitor for this company. So now that we've seen the news that Sirius put in a bid for this stock, Pandora, ticker the letter P, what's your takeaway?
Well, it's kind of bittersweet. I mean, this one, by the way, was almost as close to a no-brainer as you get because they almost hit the lows when the Spotify IPO came out. And I said, I'm like, look, I think you get a far better return out of Pandora than you'll get out of Spotify. And I said, and the valuation is so beaten up. It just wouldn't be that much of a surprise to see somebody buy them. Although I didn't, it's a little low. There is a go shop provision. I mean, so here's the one thing. Companies don't usually do what they should do. So my speculation is now Sirius has been, I think they're doing what they should do. They made an investment in Pandora, and so they're actually getting a really good deal, because I think they have like options to buy like a lot more Pandora at, I want to say, between like $13 and $15, and instead they're buying out the whole company for 10. so they're getting a pretty good deal. So kudos to them. But Sirius probably will end up with Pandora, because Apple should buy them, Google should buy them. I mean, pretty much anybody that's in this space that wants a music offering should buy them. So Amazon's in the space. I mean, and pretty much anybody could. This is a company almost anybody could buy, and there'd be no DOJ interference, I don't think, because there's plenty of competition in the space. But I mean, Google has tried to have a music offering, and everything they've tried hasn't really done much. In fact, the best music offering is just listening to YouTube, and listening to YouTube music selections by genre or by group or whatever. So somebody probably should buy them, and somebody probably should pay more or try to outbid Sirius for them. But it probably won't happen, because companies usually don't do the obvious things that they should do and buy assets at really attractive prices. So Sirius is, I think, making a very good move. But yeah, it's a little bittersweet, because I kind of figured, because the stock basically had gotten to the buyout price or close on its own. The results have been better. The stock has moved up, I think, on a combination of a little bit of a catch-up trade to Spotify's valuation, but more just better. They've had like 2 or 3 better quarters in a row. And so I don't know. I kind of think the stock would probably get to 12 or 15 or maybe even higher on its own. This is like Mule. I mean, hey, I made really good money on Mule. I caught a double or more on it. They had in fact built a really nice position. They got bought out, but I kind of think they sold too cheap. And I kind of think Pandora is selling too cheap. But this is part of the problem. I mean, I don't talk about this much because I don't really preach or get on a high horse, but this is part of the problem with we don't have an uptick rule anymore. And there are certain things where companies can trade way too cheaply for far too long, and companies just get beat up. They get tired of it. And you get really good companies that sort of give up and sell out, and when they probably shouldn't, because there's a lot of structural dynamics in the market now the persistency of trend, and algorithmic trading. Again, there's no uptick rule. It's easier to raid companies lower than to raid them higher. So again, there was very good reason the uptick rule was put in place back in the post-roaring 20s heyday, and it was basically to prevent a lot of stock manipulation, to manipulate stocks far below where they should trade. And I don't know. I'd like to see the uptick rule return someday, but I don't think it ever will be. But I think if we had an uptick rule, I don't think Pandora would be trading at $9 or $10. And I don't think it would have ever gotten down to 4 or 5. And in some ways, I actually like the fact that the rules exist in the market the way they are, because we get way more good buys on really good assets than we should. So, and I like that. It's a good setup for me and my style of trading. But yeah, I don't know. We'll see. They have a go shop provision. I'd say there's probably a 10% chance somebody might come in and try to bid for them. But I don't know. Sirius will probably end up with them. And hey, it's a good trade, good investment for me, because I was buying it cheap. At the same time, I just sort of hate to see a stock sell for a price. I mean, I can value this thing to, 15, 16, $18 pretty easily. And I'm not putting, any significant valuation on it. I mean, I'm being pretty conservative with that. So, I don't know. I think they're selling too cheap, but hey, I'll take the money and go do something else with it. But I'm keeping the shares I have, because one, the buyout's at 10, and two, there's that go shop provision. So, hey, if somebody comes along and bids, I don't think a competing bid is going to be 50 cents higher. I think a competing bid would be, a good 25, 35, 40% higher. And then I think Sirius would probably meet the bid. So for me, it's worth it. I'm going to keep it because, one, I'd rather get paid out at the full price, especially if the deal goes through fairly soon. And two, I'm willing to keep it for a few more weeks, couple more months, whatever, and see if another bidder comes along.
The interesting thing here is that it's an all-stock deal, so this one couldn't really get above the $10 level yesterday, and now we're back down trading right around 9. You have any interest in this if you think somebody else is going to come in and put in a higher bid?
I don't think I'd add to it. I don't know. I mean, if it got down cheaper, if the ARB spread became big enough, yeah, maybe. By the way, if I had to accept Siri stock, I could do that. I don't think that's a terrible price right here. But by the way, I do think this strengthens them. They took a big dump on this. And honestly, again, we see this a lot. You see stocks literally do the exact opposite of what they should do. This is a pretty small deal for them. For their stock to drop, oh geez, what was it? Almost 20%, not quite, but almost 20% on them making what I feel is a very good strategic move. Because what is Sirius's long-term risk is that, hey, that their business model just sort of erodes over time because everybody with a Wi-Fi connection to listen to music on all these services, right? So in other words, you don't need Sirius XM. This basically buys them into the space at a pretty good price. So, in my view, this is I think Sirius probably should have gone up. So yeah, I wouldn't mind keeping it. Yeah, I guess what I would do is I'd probably buy Siri over Pandora. I don't know. I'd have to look at the spread, but the deal price was effectively $10 or $10.14 or something like that. But yeah, I wouldn't mind putting having this converted into Sirius shares. That wouldn't bother me at all.
All right.
And so this might become a stock I kind of become active in because, I doubt they're done either. To me, this is a good move for Sirius XM. It gives them more competitive positioning. It'll give them more cash flow over time. By the way, they will get a ton of synergies out of this. They'll be the single best deal for them is that, on the culmination of this deal, they'll be able to take out a ton of expenses. So anyway, we'll see what happens, but I think that I think Sirius is making a really good, bold move here, and I could get more. I'd be much more interested in the stock long term now than I was before.
All right, let's go to a couple of listener questions. Are you cool with that?
Fire away.
All right.
Yeah.
So the first one we want to talk about is Veritone, VERI. You follow this one?
Well, enough to kind of know that, it kind of did that crazy big move. I kind of said it was a junk stock. It would probably, go down a ton. I probably should have shorted this and never did. But it's kind of done exactly what I thought it was going to do. It was a hype name, went up to some kind of crazy. It basically reminds me of like Tilray or Riot, which I did short, or Elfin, which I tried to short, but I couldn't short Elfin. So it's kind of one of those. I don't think it doesn't have. I do think it's a real company, from what I gather, but really low revenue base. In other words, like Elfin and Riot were, I don't know. We'll find out over time if those were more like stock scams. I wouldn't say Veri is a stock scam, but I just don't know who in the hell was buying that stock at 45 or 50 or 70. This is kind of a hype name on AI. I do think they have good revenue growth. I'd have to go back and look. I think at one point they did, but again, real low revenue base. I don't know. I should have shorted this thing. My guess is I probably tried to short it and there probably wasn't a borrow on it. And then maybe the option premiums were just crazy, or there weren't any. There might not even been options when I wanted to short it. So who knows? But the bottom line is, the stock, has done what I thought it was going to do. So it basically round tripped. It's back to 10. If you like AI, I'd go with Twitter. I mean, I think Twitter's the best AI company on the planet and doesn't get any credit for it. My other AI names, which are pure software plays, have all really worked. And so, like Splunk, I think is still officially in my focus list, but I wouldn't put fresh money into the name. No, in fact, I swapped that out for something else. Maybe I replaced that with Hortonworks or something. So AYX is another good AI name. Again, that stock's gone haywire. New Relic is a potential sort of AI software name. Again, I'm short New Relic. So, if you like AI, again, NVIDIA gets most of the credit for being the best AI stock on the planet. Again, I think Twitter is. So, but all the good software plays in the space are kind of tapped out. Although I could say that Hortonworks and Cloudera are very good plays, because Hortonworks and Cloudera are very important software tools in both Google and Amazon web services. And they do a lot of AI crunching. Their software platforms facilitate a ton of AI. So yeah, I would favor Hortonworks. I would favor Cloudera. I would favor Twitter over Very.
All right. So this one's not exactly directed towards you, but since it falls in the wheelhouse of tech stocks, I'll bring it to your attention, and I'll also get some others' input when Blue Chip jumps back on and whatnot. But this listener is curious what you think about eBay here as it's touching the 150-day EMA around the $33 level.
Well,
so
we talked about eBay. I don't hate it. It's actually had a pretty good correction. I do think it's a very viable long-term e-commerce platform. So they're very dominant in what they do, and they have a lot of ability to grow. I don't know. I don't mind it. My biggest problem is every time I look at eBay, there's usually something I like more. So for example, I don't know. I might have been looking at eBay, I don't know, a year or so back. I was probably buying things like Twitter way cheaper. Right now, here and now, I would favor my fiber optic names. I'd probably favor a FireEye. I might even favor some cheap biotechs. But it's had a good correction. I mean, if you're into the retailing, especially e-tailing space, hey, it's the best buy it's been in quite some time. For me, if I look at the chart, I would say give me another 2 points lower. This thing probably gets pretty interesting. But this is kind of one of those names. You have this expression. Does it have enough sexy? This isn't a real sexy name for me. And the other name too. I mean, they spun out PayPal. So PayPal is the name that I owned, and in fact that was one of my first big calls for briefing when I came on. I was in my very first focus list when they came out with it, and I basically said it would double, and it's more than doubled. So yeah, I mean, the best I would say about eBay is, hey, if you like e-tailing, retailing, it's a pretty good buy right here. That's not really my bailiwick, but it's had a nice correction. And sometimes if you want to play this, it doesn't always work, but sometimes that's a pretty good Christmas play. And if I were to start putting some ideas out there for kind of a holiday seasonal shopping list of stocks that could work for a seasonal type move, eBay would be at the top of the list, because I think we're going to have just a blowout holiday season this year. So if you're looking for something that could have very, very nice spike, kind of post-holiday spike results on shockingly good numbers, I think eBay would definitely be one of those stocks.
All right, interesting, good stuff.
Yeah.
All right, so one more that I have here, and it's regarding one of the names you talk about quite a bit, MTSI. Let's take a look at this one on the chart. MTSI trading down right around the $90 area. You doing anything with this one? It really hasn't done a whole lot.
Yeah, well, MTSI is 2025. So yeah, I like this name. I mean, this is probably one of my top 4 fiber optic names right now. It had a very nice move post earnings. It's these guys It's funny. It doesn't matter if they've sold off on China News 10 times, 20 times, 30 times. I'm literally not exaggerating. I think this group has sold off on negative China headlines 100 times. I mean, and maybe it may have sold off 150 times. So it's somewhere they've sold off on negative China News somewhere between 75 and 150 times. And so it doesn't really seem to like, again, we had an uptick rule, or in the old days, this just wouldn't happen. You know, you get to a point and the same news wouldn't make a stock go down again. But in this day and age that we live in, the same news will make a stock go down almost an infinite number of times until the things cycle through and it becomes an anointed name and doesn't go down on bad news anymore. But no, I think it's a great buy. I mean, I'd much rather buy MTSI than eBay. I have enough of it. I have what I would consider, close to a full position. I have room. I could buy more of it, but I'm pretty content with where I am. I'm pretty content with my fiber optic positioning. In fact, I'm very happy with it. I'm very happy with my position in this name and other names in the space. And I will trade it. I mean, it's probably close to, anything with kind of a 1950 to high 19s handle. I can snipe it for a trade. I can buy it at 1980, and if it goes to 21, sell it. I'll do that trade 100 times. But yeah, the only thing that really makes any sense that the fiber optic stocks have kind of, they had gotten a really nice push because they made a hard fundamental turn and they all reported pretty good last quarter, but they've just sold off on this China trade news again. I mean, again, for the 75th or 100 or 120th time. So it doesn't make a whole lot of sense, but that's the way it works. So if it gets crazy enough, I'll buy some more again for a trade. But I'm not worried about the name at all. And by the way, isn't it interesting too that I think this is one thing you and I talked about. So, and this is not a political view of mine at all. So, but my view is that we benefit far less from China trade than China does. And so, whether you like Trump or indifferent of Trump or hate him, the one thing I will say is I 100% agree with the trade policy of China, because this has been a huge problem for tech, dealings with tech, especially tech, intellectual property theft, all that stuff. I mean, I've been dealing with this stuff for 20 years. I remember when Cisco had a lawsuit against Huawei, and Huawei was literally printing, so they were literally printing off the Cisco operating manual when they were selling Huawei routers. That's how closely they were copying Cisco routers and selling them for a huge discounted price. So they weren't shipping a Huawei operating manual with those routers. They were shipping the Cisco operating manual. So the fighting this trade issue in a very tough way will actually have very good long-term benefits. I mean, so this should have been done 12 years ago, 15 years ago, 20. I mean, whoever, pick a time frame. This dealing with China trade issues in a totally different way has been needed for a long time. But in the meantime, the stocks face some headline risk, even though there's not that much real actual business risk to most of these companies. And yeah, do they all have various business dealings, and do they all have sales that potentially go into China? They do. But first of all, are they going to lose much of it because of the trade stuff? Probably not. And secondly, is there even a ton of it to lose? There's one stock that is heavily weighted towards China business, and that's Neon Photonics. The rest of them don't really have a ton of China exposure. And it's interestingly, Neon Photonics hasn't really traded as poorly as like Finisar and MTSI and Acacia have. And those three companies have far less China exposure than Neon Photonics does. So again, it doesn't make a whole lot of sense. But yeah, I'm just kind of watching it. I think the best thing I like about this group now is we just had the first good quarter, and it wasn't really a good quarter. It was just a quarter off the bottom. We haven't really even seen what good quarters look like out of the fiber optic stocks, and we also haven't seen a good fiber optic cycle really since early 2016, which carried, that was the cycle that carried light from 20 to 45, $50. over a number of quarters. And that was the last time. Finisar, I think, went from 14 to almost 40. I'm trying to think. Infinera went from, I want to say, 8 or 6 to 18. So anyway, the bottom line is, I think we're poised to have a good fiber optic cycle. I've been writing about that for a long time. But again, it's a long. It could be a 3, 4, 5, 6 quarter cycle. And 5G is much more important to the fiber optic cycle than China trade fears are.
All right, I think that's a good place to leave off. Any parting shots before we send off for this chat?
No, the only parting shot that I have is we have seen some really good action on ACAD, ACAD.
Mm-hmm.
I've given a couple updates on this. I've yet to sell any. And I got a question the other day. Hey, are you taking this off? I think that was around 19. This thing's had a big move, almost a 6. At 19, it has a 6-point plus move off lows. This is again. I think this is a classic case where stock overshot to the negative, it can make a big percentage move and still be pretty cheap, and that's kind of where I'd put them. The only reminder in the closing shot I would have is I do think there's a lot of cheap spec biotechs kind of in the same situation that they've sold off for no other reason other than the price was going down. So the powers that be made prices go far lower just because the prices had already come down, right? So whether it's a DVAX, whether it's again, any number of these names. But again, I'm ACAD starting to get. It's going to be another one of these biotech winners. Again, I'm sticking with it, and I still think it's a relatively cheap stock all the way into kind of like the 24 to 28 range. At 28, I really wouldn't call it cheap anymore, but it's not necessarily expensive. But again, at 21.34, I still think it's cheap stock.
Did you put a price target on this one?
It's hard to put price targets. I did put a price target on ICPT when I added it, and now that's about 20 points above. Even my quote is I viewed my price target as conservative, and now it's under review. So it's price targets on bios are hard because when the news turns, the percentage moves in these things are they don't move in 10 and 20 and 30% moves. They kind of move in 1 and 2 and 3x type moves. But I guess here'd be a better way to say it. A director just bought 1.2 million shares at approximately $19. I think that's kind of interesting. I don't think people realize it's not so much that the drug that they have approved for one small thing. Everybody's made a big deal about the sales for that area. What I would say is, well, what's the pipeline? So what other things could that drug be approved for? How many other drugs do they have that might be similar to that? So people forget stuff like that. Again, this was probably a $35 to a $50 stock before they ever had a drug approved, and yet once they get a drug approved, then all of a sudden it's a hateful thing. This is kind of a classic thing. By the way, I still like ICPT. I got to figure out where that thing might trade now. Price targets are tough. I would just say that. Well, it traded from 40 to 50, before they really ever had a drug approved. So in my view, the company's more valuable today than it was before they had a drug approved. So now you got to be a little careful with that though, because what if people were wrong in their assumptions at that point? Hey, I bought the stock as high as like 25 and 30 and made good money on it in the past, and on runs in the low 40s and things like that. So I'm at least holding mine until it at least goes up to where I've sold it before, where it's traded. In fact, you can almost draw. It's got like a hard line of resistance at 41. So we'll have to see. But 41 is a double from here. Now, I'm not going to say I'm not going to sell a single share of it from between now and 41. I probably will sell some because I bought some of this pretty cheap. But you know, I'm not in a big hurry to do anything on it, and you know, I don't think it's a super expensive stock at 41. A lot depends on what their next like 3, 4, 5 quarters of sales look like, and if they get any more traction on more approvals. I mean, here's my speculation. My speculation is the drug that they have approved for one tiny little aspect of mental or a mental degenerative treatment, which is the dementia for Parkinson's. What if they get a treatment for Parkinson's? What if they get a treatment for Alzheimer's? I mean, Lord knows what the sales would be of the drug then. So, you know, that's the thing I'm thinking about. So, I mean, it's very likely I'll keep at least a partial position of this quite a while, in just in case that eventuality were to happen. I mean, if they become a treatment drug for broadly for Parkinson's, I mean, I don't even know what sales would be. I mean, I think their run rate's about 200 or 300 million a year right now. I mean, I'd have to think that would be 8 to 10x that. So, because there really aren't very many good treatments. There really aren't very many good drugs for the treatments of Alzheimer's, Parkinson's, or any of these memory wasting diseases. And that's kind of my big thing. I think if there's the big area of biotech that needs a lot more improvement in R&D and drug treatment therapies is that, because that's going to cost the global healthcare system a ton of money, with the global aging population and things like that. And I kind of suspect it's a highly treatable disease. We just need more. I mean, if put it this way, if we were to put similar money into the treatment of these memory and neuromuscular wasting diseases as we've put into cancer treatment, we would have lots of therapies for them. So, but it's kind of happening. It's starting to be a much bigger treatment area. But yeah, so we'll just have to see. But that's one. I mean, now I will say this: I'm more inclined to buy ACAT on dips now, and I did make a pretty good buy, and I want to say low 14s. I think I was my last buy. I'd have to go back and look at my briefing posts. But you know, you give me a 2-3 point dip on this thing now, I'm probably in there, adding to it.
All right. And then here's the last one. One more listener question wants to know, what is your price target in FireEye? FEYE.
Let me look. 25.
25. All right. So still significant.
And by the way, at 25, same thing. I always put especially my first kind of targets. Like once a stock meets something, I can juice a target up quite a bit. But I always put them pretty conservative. Like, so in other words, do I think that's like a cap? And do I not think FireEye could trade above that? No, not. I mean, I think FireEye could trade well above that price. But it's got to get to 25 before it goes to 40. You know what I mean? Mm-hmm. So right now it's 25. It could pretty easily be 32 to 35. By the way. It would still be a very cheap stock on relative valuation metrics at 30. I mean, at 25, it's still probably a 35 to a 50% discount to most of the other companies in its space. And it's starting to act a little better. Again, if there are two stocks that just were completely weird, how weirdly they traded after they reported this quarter, was FireEye and Twitter. So, and I think we'll see both rectified. And Twitter just really strange because there's been so much bad news on Facebook, and the bad news on Facebook is a direct benefit to Twitter, yet it goes down with Facebook. So again, it'll get worked out, but just a very weird. I mean, this is just been one of the weirdest years ever. Really has. So there's no reason it's going to change on a dime. It's probably going to be the trading dynamic that we've been in is probably going to persist for a while.
All right. Well, I do see that this one, FireEye, has broken a downward sloping trend line, so it looks like...
well, yeah, remember when I talked about the channel?
Mm-hmm.
I've talked about that channel a ton of times, that downward channel. The break of the channel, in fact, was like, what did I say, 1640 or 1680 or something, maybe even a little lower. But yeah, no, I mean, it's broken that channel now. Now it's above this very, very insidious downward channel. I don't really see much where's my resistance on it? I don't have much resistance on it till about $19. And then, I mean, there's all sorts of Fibonacci points between here in 50. The next, I would say 20, that 19, what did I just say? The $19, 19 and change resistance. 21's been a big level for this thing too. I really think this thing could trade so much differently if it got back kind of 21, 22, 23. But again, it's got to get there first. But that's been a plague for the stock for literally for years. That $20 to $21 level.
All right. Well, we'll see if it can test that one. I can certainly make a case for it. Looks like I can see it on my chart right now that that 20-ish area, especially since we've broken through that downward trend line. So it does look good. This daily chart now starts to look pretty good for FireEye. So. And looks like we're maybe establishing a inverse head and shoulders.
It could be. It could. I mean, again, there's just this is one where the quarter really was good. I mean, just sometimes you just get very, very odd, strange things and strange reactions. But of all the stocks, I really thought that should have gone up on the results and instead got rated. Now, Twitter should have gone down. I mean, Twitter. I'm not saying Twitter shouldn't have gone down on their results because they probably overshot it to 46, but it's just gone down way, way more than it should have gone down on the. In fact, I thought it went down way too much when it was around 32. But this again, FireEye could have gone up on the report. I mean, the results just were that good. And I think what you're going to see with FireEye is quite a number of reports that show kind of accelerating improvement. Accelerating revenue growth, accelerating billings, accelerating, deferred revenue, all that kind of stuff. And that's the stuff that really makes software stocks sing. I mean, that's data traded kind of weird. I mean, data, years ago, this Tableau software, they had that huge drop, which, by the way, was deserved. I mean, again, I don't know what anybody was smoking buying data at $133. So then it went to 40. Again, it was overly cheap at 40. It was a big overshoot, but the drop was deserved. A huge part of that drop was deserved because the stock was just completely had overshot to the upside. And then, again, they made this transition to go more subscription-based, and that's what FireEye has done. But they're starting to get into that tail end where the subscription revenues now have had a number of quarters to add up. And again, you go back and look at charts of Adobe, go back and look at charts of Autodesk, other stocks that have made these transition to subscription. Again, data is a perfect example. These stocks that make these transition to subscription models, they kind of trade tough and ugly for 4, 6, 7 quarters. Once you get it's somewhere between like 5 and 8 quarters of where they've made a huge transition to subscription. Usually those stocks start acting a lot differently again. Just go back, look at Adobe, Autodesk, data, things like that. And in fact, Adobe's gotten way more credit now, I think. I mean, this is a stock that was at one time a $30 stock, and now it's a high $200s stock, largely on a revenue recognition model. I mean, again, so it just shows you, though, probably how ridiculously cheap Adobe was at 30, by the way. When it was 30, it probably should have been trading around 60. So that, it was super, super undervalued back then. But again, what did they have? They had lumpy results. They'd beat for a couple quarters, then they'd have a bad miss, then they'd beat for a quarter, then they might miss for 2 quarters. So it was an inconsistent reporter, which people had a hard time valuing. All of a sudden they don't miss a quarter for 8 quarters, and the stock goes up a lot, right? So I think FireEye just has to go through that period where the results become more consistent and they just quit missing numbers. The numbers become more consistent, the beats become more consistent. All of a sudden they re-rate this thing way, way higher on valuation.
All right, I guess I lied. I'm going to give one more listener question.
Hey, man, I can stay on as long as you need.
I know. Blue Chip has to jump on at some point, too. So I got to rein it in just a little bit here. But I do know that this one gets asked about a lot, and that's Redfin, RDFN. What are your what's your takeaway in this one?
Well, my simple takeaway is I like it better now than I did probably the last time we talked about it, because it was probably $1 or $2 higher the last time we talked about it. So Again, this is my, this is kind of my go-to favorite cheap growth stock that could be a spectacular deal. I've had many of these. I mean, I was on Coop when it was cheap. I was on Nutanix when it was cheap. I was on Mule when it was cheap. I was on I wish I was still in some Okta. And honestly, I think I like Redfin almost better. Well, I don't know if I like it more than Okta. I probably like it more than all the other companies I named, though. So I think this will be a massive, massive company someday. And again, people put way too much emphasis on what quarterly earnings reports and 1 or 2 or 3 cents of earnings mean. So, I think over time, when this company is 3 or 4 or 5 or 10 times bigger from a revenue standpoint, I think people will be shocked what it's worth, what its market cap is. So yeah, I mean, I like the stock better now than I probably did before because it's a little cheaper. So the fundamentals of Redfin haven't changed. I think the whole real estate sector is dealing with the fact that real estate's been very good, very strong. Housing prices have risen a lot. So now there's a little bit of a fear of rising interest rates, rising mortgage rates, with the backdrop of that house prices are a lot higher. So that's probably slowed down. Even Redfin said, real estate activity has slowed down markedly in recent weeks and months. So that that's going to put a crimp on short-term results, but it doesn't change the power of the company. It doesn't change this is going to be, in my view, a very disruptive company. But yeah, so I don't. There's no reason for me to have a view change because they do operate within the real estate cycle, and the real estate cycle just isn't great right now. But in the whole scheme of things, it's not like mortgage rates have risen a whole lot either. I mean, that's the funny thing. Mortgage rates are still very attractive and pretty low. Maybe we just need a period where people digest higher house prices. I mean, they're especially high on the coasts. I don't know what Chicago real estate. My guess is Chicago real estate's gone haywire over the last 4, 5, 6 years too. So
Not really.
oh, it hasn't.
Yeah, I don't know. Relatively
Well, property
speaking.
taxes in Illinois are literally insane. I lived
they
in
are.
Illinois one time. I paid
agree.
property taxes on a house. I think my property taxes there were 8 times higher than they've been in most other states I've lived in. So that probably puts a huge crimp on the ability for real estate, especially home prices, to rise. So that's a state taxation issue maybe there. But no, I mean, you talk about Florida real estate, the New York, again, any sort of sought after East Coast, West Coast property, is just a lot higher than it was. And so the real estate market's probably has slowed down a little bit, and now people are going to have to digest. But again, Redfin is a market share story. It's not a current quarter EPS revenue story. It's again, if the best way to understand Redfin is to think about what before the existence of E-Trade. And then when the E-Trades and the Ameritrades, by the way, E-Trade, if you look at a chart of that, the last 20 years, it's been a monster. But discount brokers changed the model for the financial services industry. People used to bet, 100 shares of IBM was $150 trade, meaning transaction cost. Now it might be $1, right? Or less. The industry was disintermediated, the pricing of the industry, and that's exactly what Redfin's going to do to real estate. Again, I've said this before. The only thing I watch out for, and the only thing that would concern me is how many Me Too copycat companies is Redfin going to have to deal with. So far, I'm sort of surprised. I don't see any yet. So I'm sort of surprised that nobody's basically come out and tried to copy their model. I think what's happening is maybe just people are trying to shave real estate commissions a little bit here and there. But again, this is a company that's changing the model for an industry. And if you bought into that with, with the advent of financial services, you did very well. It'd also be similar to, there was a time when you could buy ICE and NASDAQ and CME same kind of theory, same kind of thesis that you could have bought the exchanges, and those have all ended up doing really, really well too. So that's right. I mean, Redfin's a unicorn that we're all able to buy it before. I mean, if there was an if I would have been able to buy Airbnb as a publicly traded company a decade ago, I would have. But Airbnb is still a private company. But that's that's Redfin. It's somewhat similar. So we'll just have to see what happens. I could be wrong, but I usually don't get this kind of stuff right. It's actually pretty easy to make these kind of calls. The hard part is not getting dismayed or dissuaded because the price doesn't do what you want it to do in weeks. And you know me, I don't really care about that. So I don't, the things that bother most people don't bother me at all. I don't have an expectation that a stock needs to move just because I bought it yesterday. Stocks move when they move, not because we want them to move, and they move in very large percentages. Most people try to think of stocks that are linear. Stocks are not linear creatures. When they move in logarithmic type movements. They don't move in linear movements. And I don't wish for things. I just do my work, and what happens, and try to hit way more right than wrong. And but no, the only thing I probably have to be careful with is being overly confident about my thesis in Redfin. Because if you get overly confident in anything, then you lose your objectivity. But I tend not to do that either. I just don't know when I'm going to get paid. If it takes 2 years, it'll be somewhat disappointing. But I'd still rather make 200 or 300% in 2 years than try to trade a bunch of names that I don't have nearly as much research and thought and conviction in.
All right. Well, I think that's a good place to stop, because that's a good, valid point that we could all learn something from and stash that into our
well, and by the way, it's not that I don't.
Tips.
I catch plenty of things pretty quick too. So it's not like I don't have plenty of things that I do catch in pretty short periods of time. That helps me. That helps me kind of ride out things that might take longer than I expect them to. But yeah, I mean, there's a lot of times I hit stuff and trade stuff and catch things pretty quick, and do a lot of short-term trading, but which we don't talk about a whole lot. But yeah, I mean, so yeah, if a Redfin takes an extra 2 or 3 or 4 quarters, that's fine. I'm going to close on that. I am thinking about maybe nibbling a little bit more, but I've bought some at similar prices to here, so I don't really feel I need to. But yeah, it's interesting. I'll have to see kind of how it trades through Q4. What I'm hoping is there's a bunch of people that kind of puke it up for tax loss sales. And so, I always like to do that if I can get some really good year-end buys, because, people just sell stock for tax losses. That's something I always like to take advantage of.
All right. Well, we'll have to keep an eye on that. So I guess prices may go lower in Redfin before they go higher if that happens. So just I guess that's a warning for the listeners. If you can't take the pain in this one, at least he warned you on it.
Well, I mean, it just kind of happens that way, right?
Right. Well, I mean, full disclosure, right?
Oh yeah, stocks that haven't traded well through the year tend to be the stocks that get the most victimized for tax loss selling. Again, so what am I trying to do? I'm trying to do the exact opposite of the masses. I like to buy the stocks everybody's puking up for tax loss sales, and then they usually become pretty good January effect stocks. Not all of them, but I don't know if you remember, my January effect basket last year was like 90%. So I'm not saying it returned 90%, but I think I hit about every 9 out of every 10 stocks that I projected as a good January effect stock was. So this could be another really good year, by the way. Not to keep extending our time here, but the January effect tends to work the best in thin markets. So in a market, and again, we've had another year where it's a very thin market, very small number of winners. So, you have lots of stocks that haven't performed nearly as well as the small number of stocks that have. That creates a huge number of stocks that probably get sold for tax losses, which shouldn't be, but they are. And then, you can have a whopper of a January effect. So the setup's almost identical to last year, actually.
All right. Well, guess what? That gives us something to look forward to in the dry period after the earnings season
That's
plays out,
exactly right.
and
Yep.
we'll have a Christmas list of stocks that you'll come up with for us. How's that?
That's good. That's good.
All right. Well, as always, my man, good stuff. I got this recorded, so hopefully we can listen to it again if anybody missed anything. But as always, Sean, thank you so much for that time.
Have a good one. Take care.
You too. Thank you so much.